Yo, what's up YouTube? Thanks so much for joining my channel. I'm Devon Edwards and I'm going to go into a little bit more detail with a often overlooked concept of trading. This is risk management. Guys, in this extremely difficult environment, you need to understand that one of the most important parts to trading is risk management. It is easy for a lot of people to forget about the possibility of risk and always focus on the big, large profit potential, which is the reason 90% of traders lose. However, you must remember that the most successful traders in the world are often the ones that understand the difference between managing a risk and getting large profit. There is also big potential within the Forex markets of massive profits, guys. But the most important thing that you need to understand is that a successful trader needs to protect his downside. In today's video, we're going to dive into the fundamental trading concepts, strategies, the common mistakes people make, and also, guys, the psychology behind it. Let's start it. Okay guys, so let's go into a little bit more of understanding what is risk management. Risk management is literally the basic concept of understanding that you have risk in the trading markets. It is an easy way for you to make sure that you do not lose your money in the trading industry. Okay, we have so many people that blow their accounts, get frustrated with trading because they haven't actually got a strategy that keeps them in the market for long enough. So what we want to actually explore here is risk management is identifying the possibility of there being a loss on your trading accounts. And the way you do this is by creating a good enough analysis and trying to make sure you can mitigate as much possible risk there could be. This means you guys need to make sure that you're taking the appropriate actions in order to make sure you do not lose a lot of your money within the markets. It is also one of the most important parts of trading, guys. Without risk management, you will never become successful. I don't know if any of you guys have ever seen trading video, whatever, and you've just seen entries upon entries upon entries upon entries, all the way to the top. This is what I call problematic trading. Okay, because the thing is, guys, at any given moment the market retraces and you do not know when it will do that. This is why we have risk management. The great thing about understanding risk management, guys, is that if you are even the worst trader in the world, but your risk management is good, you will be able to stay in the markets long enough to become successful. This is why I plead and beg you, make sure you have a good risk to reward ratio, and this will keep you and your trading accounts in a good situation for a very long time. Okay, so let's make sure we understand why is risk management so important. Guys, if you do not have something called an SL, okay, a stop loss, what can happen is the market can reverse on your position, whether it is a buy and the market is retracing back up, or if the market is selling off and it is pulling down. What sometimes tends to happen, guys, is that your analysis or your perceived idea of the market doesn't go in the right way, and therefore the market reverses on you. And what happens is, if your buy is at this point in the market, it can sometimes literally be going up and then it can pull back down. Now, if your account starts to go into the red and you don't have a stop loss, there's no way for you to all of a sudden be like, oh no, anyone has to, you can't do anything about it, the market will keep moving. And the worst part about that is you just watch your account go to zero. You do not want to have a loss so severe that it actually causes a problem for you. When we have a good strategy, guys, with regards to risk management, what this allows you to do is if you take a loss one day, that's part of the game, bear in mind. You're going to lose some money. If anyone told you something different, they're lying. You're going to lose, but you can determine how much. This is the best thing about risk management. You can trade it today and take a loss, and then get that opportunity to actually trade the next day. So with a good risk management strategy, you will be able to stay in the markets for longer. Once we have gone through a loss for the day, what this allows us to do is to do some analysis on that position that we lost in. And at the same time, guys, once you've made a loss, the best thing to do is watch the market afterwards. Because once that happens, you will now get the ability to actually do some, backtesting. Why did my trade go wrong there? And what can I do to improve? These are the steps you need to be taking. And this is why risk management is so great. Because if you don't have that specific amount of money predetermined in your trading strategy, then what's going to happen is you're going to lose a lot more and your account's going to decrease a lot faster. So let me put this into easier words. For example, if you have a trader that is risking 50% of their entire account on a trade, how many trades does that actually give them to find a position in the market? 2. But they can be correct, I agree, and then they can make double their money or even triple their money. But the problem comes is when your trading plan isn't as effective as you think it is. Now, if you're risking 50% of your account, therefore, if you trade once, you're now 50% down on loss, and you only have one more attempt to make money. So you only got 2 consecutive losses, as opposed to having a risk that allows you to trade 50 times with a 2% risk. Don't you think you would have more opportunity to gain a percentage of your accounts time and time again? You can literally strategize a better scenario over time with an effective plan rather than having 2 trades. Like, that is very, very risky, and I would actually consider that gambling. And on top of that, guys, you can go through a losing streak and it would not have affected your accounts at all. You could have lost 20 times and you've only lost 40% of your accounts. And my favorite strategy is to risk 1 to 2%, and you're looking for something between 3, 4, and 5 times your money. So now let's just put that into perspective. If you're risking 1 or 2%, right? Let's put it on the high end. You're risking 2%, and you do make a good trade, and it hits that 4x. You're now making 8% on that trade. Okay. Now you can go and lose another 4 trades and you still haven't lost any of your money prior to that trade. So this, guys, gives you the opportunity to keep moving forward, keep learning, keep executing. And once you get that fundamental understanding correct, my word, you are going to be so impressed with your actual returns. Okay, guys, now we're going to go into the fundamental concept of risk management. The first fundamental side to all of this, guys, and I mentioned it earlier in the video, is called a stop loss. What a stop loss does is just prevents you from losing any more than you would like to. For those of you that don't understand this or never done it, it's just as simple as this. When you execute a trade and you get a buy, okay, the market executes and you have printed a position on the charts. Now, what you can do is you can establish another line or another position, which would be your stop loss, okay? And then your profit would be slightly bigger than your stop loss. So we want to make sure that we have a good ratio from risk to reward. And in doing this, like we said in the previous part of this video, if we have these things in place and you're risking this much to gain this much over and over again, sooner or later you will find a position in the market where it gives you that profit. Now, a rule of thumb is always never risk more than 1% in a single trade. Okay, so what I like to do is to make sure that I break that 1% up into a few trades. So I'll do anything from 0.5% or even 0.05%. And depending on where the market is, I will determine my risk. And I'll definitely give you guys an example of this later in the video if you stay. Sweet. So now that we've actually gone through the whole fundamental concept of trading, I'd like to just branch off into what I was speaking about earlier with regards to the risk to reward rate. So with regards to that, let's give you a basic understanding of that. So we want to make sure that we are risking a certain percentage of our accounts. If we trade with a lot size and you're uncertain about like how much you're going to lose, it's very easy to actually determine what that is if you are on your computer. And I highly suggest, guys, you do trade on your computer. I will give you a easy to do risk management calculation. Then you can go and literally times it by 1% and see what that is. And if it's not that dangerous or it doesn't feel too scary for you, then I really do applaud you, go for it. Then what we want to do is we want to take that calculation and we want to times it by 3, 4, or 5. And those will be something called your target profit. Okay, TP, take profit or your target profit, whatever you'd like to call it. Remember, the whole concept of risk management, guys, is to become profitable over time. So if we think about it like this, it's simple, very nice calculation you can do for yourself. Now let's put it into perspective where your trading strategy is only 35% correct. Therefore, if you have a risk to reward ratio of 3, 4, 5 and you only are hitting 3x on your trades, did you know that you would actually make nearly 90% back on your account if you only had a 30% win ratio? So you only would have lost 10% in your entire trading period or cycle, you could call it. And that is brilliant. That is exactly what I'm trying to get at, guys. It's not about hitting these crazy, massive winning trades that you see some guys hit. Those only happen maybe 3 times in a month. So trying to strategize for that is very difficult, believe me. You need a lot of different news and activity in the markets to bring about these incredible movements. Believe me, I know, I've seen them, I've been in them, I've lost a lot of money because of them, but now because I understand the risk and reward ratio concept, I've been able to keep myself in the markets for a lot longer. Get yourself to making actual profit on your account is the most important part of trading. Okay guys, so here's my easy example for you guys to understand. Let's say for argument's sake, we have had 130 trades, okay, and 100 of them went wrong, risking $30, okay. So now we have technically lost $3,000, which is like, whoa, okay, what have I done wrong? But what happens after the next 30 trades? All hit their 3x. So therefore, guys, you would have hit $90 per trade, okay, and you would have done it 30 times. That means you guys would have technically made $2,700 worth of profit. Now you've only $300 down on your account. So the risk to reward ratio keeps you in the game for longer. You want to implement this as soon as possible, and you need to get to understanding it and being as diligent as possible in it. What I want to show you guys now is what I normally do in my analysis for trading, okay? And it's very, very simple. I won't lie, it's actually too simple. And once you guys see this, it's not going to take you long to figure out what you want to do, guys. Just please remember, the whole concept of trading is to have a plan first and to know exactly what you want to do and how much you're going to risk. So before you even trade, I want you to write down what is your trading account size. Do it here with you. Let's do this together. So we're going to go here. Let's do it together. My trading account size is $6,000. So let's write it down. $6,000. Boom. Okay, so we are only allowed to risk 1% of that. Now let's do the calculation. 6,000 times 1%, which should give us $60. Okay, so that is the maximum amount of risk you're allowed in your trading day. Okay, now don't trade it with one trade throughout the day. That doesn't make sense. Okay, what we want to do now is we want to break that up into, like I said, different trades. So we're going to divide it into 4, okay, which gives us $15 to trade with. Okay, very easy, simple, and straight down to making it easy for you to navigate and have a few more trades rather than feeling so cucked when you trade once and now you can't trade anymore for the day, which wouldn't actually be a bad idea for you to feel. Okay, having one trade a day actually is incredibly powerful, guys. It'll give you more time to look at the market and navigate through it than to constantly trade and revenge trade and go back and forth with regards to, did I get it wrong? Oh my God, it's gonna go. And please, guys, don't have FOMO. There's no point in having FOMO in this. There's always another day to trade. Okay, so let's dive into this quickly. Now that we are ready to jump into this whole beautiful concept of trading, of risk trading. Of risk management. Let me just quickly show you how I do mine. Okay, it's not complicated, it's very simple, and all you need to do to actually get this into your head is please use a computer. Otherwise it's going to be very difficult. You're going to have to take a trade, then you're going to have to exit the trade on your phone to figure it out, which is very dangerous. Okay, but you can still easily do that. Okay, you can just trade with a very, very small lot, which is a 0.01, which is your smallest lot size. and then you can basically bring it up higher, or you can times it by the factor it is. So if you wanted to know what a 0.02 risk would be, then you're going to enter a 0.01 and you're going to take the trade out immediately. You're going to enter the trade, you're going to let it fluctuate a little bit, you're going to exit the trade. It shouldn't really damage your account whatsoever, guys, and hopefully it goes into profit anyway. But the main thing is, guys, that whatever you find out the differences between your pip sizes or your point sizes is, you will know exactly how much you're risking per point or per pip if you do that equation. But let me make it way easier. If you have a computer, it makes a lot more sense to go into it and do this. Okay, I use something called TradingView to do all of my analysis, and it's very simple if we just go and look at it from this perspective. Okay, so I'm going to dive here into the NASDAQ. I don't know why this thing is not letting me move it. There we go. Okay, and then we're just going to click on here to go into the actual size of it. What I want you guys to do for me is, as you can see, guys, I've already got a pre-planned trade here. Okay, now if you wanted to see how I'm going to trade this, it's very simple. So I use something called the Fibonacci retracement tool to actually figure out where I'm going to trade. Now, you use the Fibonacci only on impulsive legs. So, and I trade in the hourly. Okay, you are going to have to decide what level you want to trade in. I like the hourly because it works with my strategy. Okay, so therefore what I'm going to do is there's an impulsive leg from here all the way to the top. Okay, I would like to include that wick because I like to, gives me a little bit more room to enter, and we can actually see that there is a decent area here that the market could hit. So what I'm going to do is I'm just going to move my line up to here, about there, and I'm also going to incorporate a area of interest for me. So just where that big wick was, I'm going to put this over here. So now, guys, I know that this area is very, very powerful for the NASDAQ. And I'm going to put my alarm there just to let me know it's there. Guys, it does not mean I'm going to trade here. Okay, this means I'm going to look at the market and see that it's done before I trade. So once I've done that, now I'm going to say to myself, okay, I like this. There is a possibility for it still to hit here, so I might wait a little bit longer. But let's say, for argument's sake, I'm going to take my trade within my Fibonacci retracement level. We're going to do this. We're going to look at it, and I'm going to say, okay, where do I want to trade? Why do I want to trade here? What is this level? So we are going to go and look at 15,375. Let's go out to the daily. Let's see if there's any support structure on the left hand side to make sure that this is a decent area to trade on. Okay, guys, and as you can see, guys, for me, there isn't enough of a structure technically, but it's still worth a buy because it is a Fibonacci retracement on an impulsive leg. So we are going to literally figure this one out. So we would like to make sure that we actually hit this area here, a little bit lower. Okay, so now that I have an area that has previously moved up from here, I'm going to actually determine my risk. So what I do now, guys, is very easy. We go back down into here and we go and look at it again. So now we know that this is the area that it could possibly bounce off. So my alarm is going to tell me when to look at the market and to look for patterns XYZ. Okay, that's for another video. Patterns and strategies that come with patterns is great. But let's focus on the concept of risk management. We are trying to figure out what is our risk. So for me, guys, I will always risk anything from 20 to 50 pips on my trade. So what I'll do there is, if I'm going to be trading somewhere within this area, I would basically say to myself, okay, cool. The lowest area I would like to trade in is within the middle of my Fibonacci retracement level. So that means it's 355, okay? And I'm only allowed 20 to 50 pips worth of a stop loss. So now what I'm going to do is I'm going to get another line here and I'm going to look for that. So that would be, let's call it 300. Then you're not going to be like perfect, guys, impossible perfect. But let's just say I'm going to go just underneath my Fibonacci. I like that. So from the blue line to my other line, I am slightly color deficient, so I do apologize if the colors are wrong. But anyway, that is not really important right now. So guys, my risk is this. This is my risk, guys. Look at this. So if we had to draw it in, this is the risk that I have. Okay, all of this. That is the risk. And my potential, guys, is anything from this, from here, okay, from this entry, all the way up to there. Okay, so how do I know that? The Fibonacci lets me know that. So when we are looking at these kind of trades, guys, you got to look at it as a potential. So let's just go and take that into consideration. So if my risk here, guys, is about 50 minus 16 into 16 is roughly like 30%. So it's within my recommended, risk to reward ratio. So we want to make sure we've got that secured. Now, guys, if I catch this trade, we are looking at anything from 35 all the way up to, it sometimes will hit this area and then retrace again. So here we go. We have got, that is such a beautiful trade, my word. Okay, so we would have a risk to reward ratio from here to there, and I'll have more than one trade from there to there, and also from here to there. The reason I know these things can happen, guys, is the Fibonacci retracement has two different levels that I like to hit. One is the 0, which is basically a retracement back to where it fell from. And then the next one is when it exponentially moves up, which you can hit the 27, the negative 27, or the negative 61.8. So this is my strategy that I use. It's called a Fibonacci retracement on a 1 hour time frame. And if we look at that, guys, my first take profit would be 15,729. Okay, if we just do a small little calculation, it'll be more than 350 points worth of a trade. So that is unbelievable if you think about it. I'm risking 30 and making 350 plus. So that is nearly a 10x. So would you take that trade? Yes? No? Maybe? I would. Okay. And also at the same time, guys, like if I don't catch that one and it goes even lower to the other level that I had, then that means the risk to ratio increases. It could be 1 to 15, or maybe even 1 to 20. But we will determine that later. Let's just say I take this trade and it does hit the first level, which is 15,729. Okay. So we have more than a 350 point movement there. Okay, so let's go and figure out how do I know what my profit can be and what my risk is going to be. So now that I have this trading plan here, okay, I'm going to leave it there, and I'm also going to show you guys that you can use this other, there's called a short position and a long position. So these are different things that you would like to do, and you can use them to identify your risk to rewards. And where is my risk? There, and my reward is up here. Okay, guys, so now you guys can see there is my risk to reward. It is 10 to 36. Can you see that's a 0? It's basically, you could say that is a 3x on your trade. Okay, but at the same time, guys, for my trade, because I have different leverage, it will be a lot more exponential. So if I risk 5, I'm going to get 15. Also, there's leverage involved. That is something else I don't really want you guys to worry about. But the main thing is, guys, there is a good risk to reward ratio here. Okay, so now that I know that, I'm like, okay, perfect. I don't need that anymore. Let me go and figure this out. So what I'll do as well is I'll go to my trading accounts, click on this, I'll bring it up. And as you can see, guys, I've got all my other lines here all over the place. So what I'm going to do is just take all that away from last week and just start all over again. Let's see what this is all about. So what we're going to do here is we're going to do the exact same thing I did earlier. We're going to make sure that I understand that from the highest level I had, we're going to go out and we're going to go find that area that I saw, which was there. Perfect, you can see it now. And then I'm going to go back down to the hourly, and then I'm going to plot in my areas of interest. Okay. And remember, guys, we're not just going to trade, we're going to wait for the market to get there, then we will trade it. Okay, boom, boom, boom. Okay, guys, So now I know that is what I wanted, right? And we were like, okay, this might look a little bit different on your trading platform as opposed to trading view. Guys, don't be freaked out about that. The patterns are still the same. You still got to go by what you see. Don't worry too much about the numbers. The numbers that you need to worry about are the ones on your screen where you are trading on. If you're trading on trading view, you're lucky, that's great. But let's just go back into this. So I am going to do the exact same thing as I did on trading view. I'm going to set an alarm. Okay, so this, when it comes into my area, I would like to know about it. Now that this has all been done, guys, now we're going to do the whole risk thing. Okay, now how do I do that? So on the top left hand side, guys, you see I have different, you have like these numbers, the sell and the buy. Okay, but what I have done is I got a 0.05 because I've been trading this account for a while now, more than 30 days. You'll get to understand yourself and also what kind of lot sizes you want to use. So all I'm going to do here is I'm going to place the trade. It's called a buy limit. So this is me entering the market without actually having to execute. Okay, it's a buy limit. So you can do this if you're someone that can't get to the market in time and you really want to make sure that that area, if it is affected, you can buy it. That's called a buy limit. Okay, so it's a predetermined position that when the market moves past it significantly, it needs to actually go through it to activate it, and then it reverses, it will actually give you profit. Okay, so this is how I determine my market value. Okay, and then I just double click on this, and then now I can put all my information in. So my stop loss, remember we wanted it to be 15,316, I think it was, that's correct. Modifier. And now, guys, you can see, look, it's in the area I wanted. Now we're gonna go check that out. Okay, it's $25. Okay, what was my risk maximum? I'm not allowed to risk anything from, remember, $15 per trade I'm allowed to risk, right? But if it's 25, how many am I allowed to risk? I'm allowed to risk 2. Because then 25 plus 25 is 50, that's very close to my 1%. We don't want to always risk 1% in our trades, guys. So therefore, I now know, okay, if the market does hit this area, I'm only going to execute 2 trades, maximum, okay? If it knocks me out, I need to walk away. That is trading psychology 101, guys. If you have a risk per day and you exceed it, you're done. You're not allowed to go anywhere close to the market for the entire day. This keeps you profitable, this keeps you in the market, this keeps you going. Now, if I wanted to check what my profit would be, now we're going to go do double click again on the line, and then now we're going to put in to take profit area here, which was 157.29. Okay, let's put that in. Okay, which is up here. Now, look at the difference. Everyone, does this make sense now? So my strategy here is risking $25 to make $181. Okay, now let me just quickly do a little bit of math again. Not the best at math, guys. I just literally look and apply, and it's very simple. So let me just figure this out quickly.
A few moments later.
Okay, guys, so now that that's done, so that is literally just take what you have, which is $25 as a risk, 181 as your profit, divide the two by each other, and you get what? You get 7 times your risk to reward ratio. So in a nutshell, guys, if you wanted to understand why this is so powerful, is that I can technically re-enter this area if I was allowed to 7 times and get one good trade out of those 7 trades, and I will have lost nothing. And if I catch it on the second trade, then therefore I'm still very profitable. So when you have a good risk to reward ratio, guys, it just gives you the ability to have more opportunities, more entries, and it keeps you alive for longer. As opposed to me now risking $108 right down there and then nearly wiping my entire risk per day out straight away. So we want to make sure that we have that 1% trading opportunity, okay? And if you do this, guys, I can more than promise you, you will see the incredible possibilities that are available to you today and for your entire future. Now I just wanted to go over the most common mistakes most people make. Common mistake in the trading markets is not setting a stop loss, thinking that the market will always go in your direction, which literally results in massive losses, guys. You don't, if we knew where the markets were going, I don't think I'll be doing this YouTube video to explain to you guys why you need a stop loss. because I would just click a button and I'd make millions.
Hey, fellas, look what I found in my pocket. Look, a year's salary right here. What I call them? Fun coupons. See that?
So that's the number one misconception of trading. You need to have a stop loss, guys. And I know it feels ugly to get knocked out, it really does, but you need it. The next one is, guys, risking too much per trade. So like I said, I have a risk to reward ratio based on a 1% of my account that is split into 4 different trades. Okay, so I have more opportunity to get my account moving. So please, guys, do not be risking too much in one trade. And also, please, guys, if you're trading on a live brokerage and you've got a big leverage, make sure you've just done what I've done so you don't make the mistake of entering a market with a high lot size and it absolutely destroys your account within one trade because you're risking too much. The other one, guys, that I really like to speak about is, please, guys, your emotions. You guys have to understand that this is going to affect you. We like our money so much that we would rather protect it rather than use it. And that's why I like trading so much, is because it's taught me that money is just a tool. You know, I can use money to make money, and that's the only way you're going to ever get anywhere in life, is if you constantly use your money to increase your income, then you are going to one day get rich, guys. But it doesn't just happen overnight. Like, a lot of people think that trading is going to bring them everything. It's actually going to bring you a lot of help. It's actually going to bring the true you to the table, okay? That's why I like it actually so much. It's one of the most unbelievable self-development programs in the world. That's why trading is so freaking amazing. So guys, with regards to what I was saying earlier with your emotional trading, please remember though, when you do lose a trade, try to step back, try to move away from the markets, and also allow yourself to just watch, okay? There's no such thing as FOMO. You might feel it, but there is no such thing. It's if every day you can trade, then therefore you should not have FOMO, because the next day can prevent another opportunity for you to get into the market. So please do not let your emotions control you. Do not revenge trade. Revenge trade means you've lost a trade, so you enter another trade, you lose another trade, you enter another trade. Guys, if the market is moving down, and it's moving down fast, let it move down. Stop trading, just watch, because then you're trying to catch a fall in life. So now that you guys have got a little bit of a demonstration, you've seen what I like to do in the markets, you've seen where I like to enter and what I'm going to do in relation to my trading size and what kind of risk I like to take. I like to make sure that I sum this all up into a very easy to understand playbook. Okay, so number one, guys, risk management is literally the backbone of any successful trading plan. Okay, it helps you prevent you losing your capital. It ensures that you stay in the markets long enough to survive any movement that might not be predicted. It will help you structure your trading approach. It will also eliminate impulsive decisions and worry in the markets. And by employing a very good strategy, believe me, you will become profitable. It's all basic maths, guys. If you can risk very small amounts of money and you can always have a good take profit over time, you will be making money because of the way it works. Like I said, with regards to those 130 trades, you need to keep that as your number one rule. And by maintaining a healthy risk to reward ratio, you will be able to learn, grow, and become the best possible trader. Okay, so guys, thank you so much for watching this video. I really appreciate your time. And I would love it if you'd like to join my community of traders. I have a free training group right here that you can join. The links will be in this description. And on top of that, guys, as my obligation here as a trader and knowing the difficulties in growing an account and all of the rest, I have partnered with 2 incredible companies, these 2 right here. And I would like you guys to remember that this is why I actually can do this. I don't risk most of my money trading. I use these prop firms to actually leverage them and then therefore have a trading account more substantial, where making 1 to 5% in a month is actually worth it. So in the beginning, open up a live account. I'll link my broker that I preferred everyone to use. They are unbelievable. And in that time frame, guys, you use a very small amount of money and you learn the concepts of trading on a prop firm. And then all you're going to do is, once you've been trading for 2 to 5 months, then you're going to take that plan and you're going to take a challenge out and you're going to pass it. And then once you're passed, you can therefore now become a funded trader, not trading your own money, and actually earning a decent income in this incredible environment. Okay, I hope you guys have a fantastic day, and please remember, keep the risks small and let the winners run. Peace out, much love, keep on.
But I've known you too long, it hurts to watch your blue eyes fade to gray as you fade away.